The average UK house price is a daunting £300,000. This figure alone can be intimidating for many potential buyers, especially first-time homeowners who are trying to get a foot on the property ladder. Interest rates hover around 5%. While this might seem manageable at first glance, the reality is far more complex and challenging. This creates a perfect storm for those seeking mortgages. The combination of high house prices and significant interest rates can be overwhelming. Let's break down the numbers to understand the full impact. Imagine a £300,000 house with a £30,000 deposit. This is a common scenario for many buyers. That's a £270,000 mortgage. This is the amount you will need to borrow from the bank. Over the first 10 years at 5% interest, you'll pay approximately £125,000 in interest alone. This is a staggering amount when you consider it's just the interest. That's on top of your initial deposit and regular mortgage payments. The financial burden is substantial. This is a huge sum of money. It's not just a number. It represents years of hard work and savings. These high interest rates are a major burden for homeowners. They add a significant amount to the overall cost of buying a home. They eat into your monthly budget. Every month, a large portion of your income goes towards paying off the interest. They limit your ability to save or invest. The money that could have been used for other financial goals is instead used to pay interest. It's a constant financial strain. The stress of managing these payments can affect your overall well-being. This situation raises serious questions about affordability. Can the average person truly afford to buy a home under these conditions? Banks are increasingly offering longer mortgage terms, stretching them to 30 or even 35 years. While this might seem appealing initially, it's a trap that many fall into without fully understanding the consequences. Yes, your monthly payments might be lower, making it seem like a more manageable option. However, you'll end up paying far more interest over the lifetime of the loan, which can add up to tens or even hundreds of thousands of pounds. This extended interest means that a significant portion of your payments goes towards interest rather than the principal amount. Essentially, you're paying more for the same house. Let's be clear. This benefits the banks, not you. They rake in more profit from the extended interest payments, ensuring their financial gain at your expense. Banks are businesses, and their primary goal is to maximize profits. By extending mortgage terms, they secure a steady stream of income for decades. Meanwhile, you're shackled to debt for a significant portion of your life. This long-term financial commitment can limit your ability to save, invest, or even retire comfortably. It's crucial to understand the long-term implications. Lower monthly payments might ease your immediate financial burden, but the overall cost is much higher. Don't be fooled by the allure of lower monthly payments. Always consider the total cost of the loan and how it will impact your financial future. The current mortgage climate has a disproportionate impact on young people. Saving for a large deposit while battling rising rents is a near impossible task. The dream of homeownership feels increasingly out of reach. This has wider societal implications. We need to find solutions. The government must address the housing crisis. We need affordable housing options. Otherwise, an entire generation will be locked out of the property ladder. It's essential to recognize the power dynamic at play. The financial system is heavily skewed in favor of large institutions, leaving ordinary people at a disadvantage. Banks are profiting immensely from the current mortgage system. Their profits continue to soar, even as many struggle to make ends meet. They are institutions designed to generate wealth, often prioritizing their bottom line over the well-being of their customers. But this should not come at the expense of ordinary people struggling to get by. The stress and anxiety caused by financial instability can have lasting impacts on families. A house only truly becomes an asset when you own a significant portion of it. Until then, it's more of a liability, tying you to debt and escalating interest payments. The cycle of debt can be difficult to break. We need greater transparency and fairer lending practices to create a more equitable system for all. Only then can we hope to balance the scales and provide everyone with a fair chance at financial stability.